of you. Peter's work is shared on
You
CNBC
guys hear
quite a
me?
bit. Yeah, hi, Peter.
Hey, how are you?
Good. Thank you for coming back, buddy. How are you?
Yeah,
Everyone
thanks for
safe in the family?
yeah, thanks for having me on. Yes, hope the same with you guys too.
Okay, Steve. So I'm going to share if you stop sharing, and we'll get Peter into it. So, Peter,
Done.
okay, thank you. So, Peter, since the summit, we've had dollar weakness, euro, finally clearing some resistance levels. So I think this must have been constructive for the positions, emerging markets, with the dollar pressure coming off. Is that the way you see it? And you looking for continuation?
I am. I mean, the euro trades pretty impressively. I've been saying this for a while. When you think about
You
all the
have.
things that have been thrown at the euro the last 5 years, 6 years with negative interest rates, sclerotic growth, a yield curve that's disappeared via the ECB, pressure on bank profits, political ups and downs, and the euro still is trading between this 105 to 115 range now, obviously on the upper end of that. I do think that the exploding U.S. debts and deficits are beginning to matter. This move above 114 in the euro coming just a day after we were told that the budget deficit through June is going to be $3 trillion, which is about 14% of GDP. Now, we obviously know why that's the case, but one thing we did not see in the expansion was any compression in the budget deficit. And a country's budget deficit definitely has a correlation to the value of its currency. And I think that that's having a factor here on weighing on the dollar, which will help, as you say, emerging markets relative to the U.S.
Okay. So what's number one on your radar screen after this major retracement? Back in March when the S&Ps were trading 2,200, calling for a bear market rally back to the 3,000 level, they wanted to lock me up. So this magnitude has surprised me. What's your take on it? And do you think that perhaps this week we're finally seeing the separation between tech and being NAS 100, MAGA, whatever you want to call it, that they're finally going to correct in some way, like they are, like today with the S&Ps being much stronger than Nasdaq?
Well, it is possible that on Monday, when we had that reversal day in the Nasdaq, that was maybe a short-term top in the Nasdaq relative to other things. Obviously, when you see names like Tesla, putting aside what you think about the company itself, but when any stock, regardless of what it's called, goes parabolic, that's usually a late phase situation. And we know a lot of the names in the big cap area have gone parabolic here. So with the dollar weakening, with hopes that we will have a vaccine sometime early next year with the success we're seeing right now, that we could get a shift into cheaper things, more beaten up things, and away from the maniacal chase into technology stocks, which have put valuations at pretty extreme levels. Not that valuations are a timing mechanism, they're certainly not, but certainly a disconnect between one area of the economy, which is still economically sensitive, relative to something else. I think that separation probably, for now, has run its course.
Do you think COVID is out of control in America and we're not wanted anywhere? We're like pariahs everywhere in the world now, Peter, and a lot of states beginning to, in fact, mayors that do no longer have the power to legal authority to call for a shutdown. The governors have to do it. Do you think that if we continue on this path that we're on, that it's not factored into the market, and people are saying the economy could recover? Wasn't this a pretty big body blow, no matter what the Fed and the U.S. government's doing with relief money? How long can that work?
So in terms of it being out of control, it's certainly in some states, but just because something's out of control doesn't mean you can't get back in control. I think just as we saw in the Northeast, sort of in April, how we were able to get back control, I think just a few weeks of mask wearing would go a long way. but this is still a traumatic experience for the global economy. It exposed a lot of vulnerabilities of the global economy that are just getting sort of band-aided up by the Fed and fiscal policy, but that those band-aids definitely wear out after a period of time. And we know in a couple of weeks extended unemployment benefits expire. I'm sure they'll extend them to some extent, but at a lower rate. The PPP money for many businesses is running out, and monetary policy has a law of diminishing returns. So there is going to be a point within the next 3 to 6 months where the economy does have to stand on its own. And even if you do get a vaccine, which I'm confident that we will, it's still a 2021 event, and we have to ask what kind of economic damage is still going to be ahead of us from now until then. How many
especially into a flu season where people won't know what they have. And, this winter could be a pretty tough season for our hospitals to be able to function.
No question. There's still a long road ahead until the masses are inoculated, again, which is not till 2021. So even if Moderna has success, we still have to power through what will still be a bumpy 6 months. And I go back to small businesses. Small businesses are living day by day right now. So yeah, today the market's celebrating Moderna's news, but that small business still has to make it out to the other side in 2021, and unfortunately, some won't. And that is again because a lot of people in the country in different parts are not being disciplined in wearing masks. Mask wearing has proven to be a success in containing the virus in many parts of Asia, and I think we should be looking to them as a template. It's not perfect, but when you look at the spread numbers and the death numbers there, it does tell you that with proper discipline, we can get through this. But right now we don't have it. Businesses are going to suffer. Confidence is going to suffer. And while 2021 hopefully will be better with a vaccine, again, we don't know how much economic damage we're going to see from now until then. So yes.
And doesn't a lot of consumer spending, Peter, come from people 50 and older? They're really the bulk of consumer spending, and they're going to have some type of, I know for myself, I'm not in a hurry to go to a restaurant. And that also, that demographic could have an impact on maybe a very weak consumer recovery.
That will definitely be a factor. And then also you have higher income people that are a big chunk of consumer spending. And even though they're certainly enjoying this rally in the stock market, they've even reined in spending. And that'll be one of the lasting characteristics of this recession, is going to be a higher savings rate on the other side. And that sort of how the Great Depression in the 30s altered behavior for a generation, I think that could be the case this time around as well, even with a vaccine. So,
I have a non-market question. New York, really, the curve was flat and it was smashed. It went back to the base. So my question is, Peter, because you're on that network a lot, is why aren't people, if New York is under control, why aren't anchors and guests coming into the studio and still doing their programming remotely if New York is so great?
Well, I still think that it's trying to be, staggered. I think that right now, until there's antivirals, they're just playing it safe, and they found it to be effective to be able to be distant and still do their shows. So
yeah, it's nice to be able to see everyone's living room, don't you think, Peter?
Yeah, it's been engaged on how people live. I do want to point out that I'm still mystified, or maybe not that mystified, but still scratch my head when you see the 10-year yield at 65 basis points.
Yeah,
where it was even last Monday.
Did the Fed take the bond market away from us after things froze, and they came in and said they were going to back corporates and high yield? And TLT used to be a great trading instrument. It's not anymore. You almost have to make an appointment to do a trade. Has the Fed taken away another market from us?
Yeah, unfortunately for now, yes, just as the ECB killed the European bond market and the BOJ did the same in Japan. I do think, though, there is still some hopeful market signals in the Treasury market, and it hasn't been completely killed, but we don't know. I don't know whether the 10-year yield at 65 basis points is telling me that we still got a long road to hoe here in the economy, or it's telling me that the Fed's going to do yield curve control at some point, and the Fed's still doing QE, and I don't care what's going on around me. I'm going to continue to buy treasuries. So I'm not sure, but I think it's probably a combination of that. And being a combination of that still implies that there's still some economic signals that are filtering into the long end of the curve. And those signals certainly are being interpreted in a much different way than certain areas of the U.S. stock market.
Yeah, it looks like an EKG, right, of someone in a coma. So, okay, so we have uncertainty, and that not really being able to, like, you want to price risk, you'd like to be able to really price interest rates into that model. It's hard to do that. I do want to congratulate you. I remember asking you last time, and you've been constructive precious metals for a few years now, Peter, and I think silver had made a decent run. And I said, what do you think about silver in here? And you said, still has, quote unquote, still has a long runway. So we've gotten a lot further down the runway, challenging some yearly highs. I'm assuming that you're still bullish, constructive precious metals here.
I am. I think we will continue to see falling real rates. I think that in 2021, the story will shift to inflation. I think people don't appreciate the supply side disruptions that this virus has caused.
Okay. Yeah.
And that when the global economy continues to rebound, and if we do get a vaccine, that the demand for goods and services will overwhelm the economy's ability to supply it. That will lead to higher inflation, that will lead to even lower real rates and higher values of precious metals. Silver, about half the demand is still industrial, so it does have economic sensitivity, but it has economic sensitivity in secular growth drivers like electric vehicles and renewable energy and electronics and so on. So I still think there's a lot of catch-up play in the price of silver relative to gold. Both will go up, but silver has the opportunity to really outperform gold here on the next leg higher of what I believe is now, is a bull market in precious metals. Okay,
so even down here, and I'm showing it, Peter, the magnitude of the gold-silver ratio coming in, where you could have gotten 125 ounces of silver for 1 ounce of gold, all the way down here at 94. You're expecting a continuation of the gold-silver ratio to contract.
So if you extend that chart to the 1970s, when we came off the gold standard, the gold-silver ratio on average is about 60.
Here you go, Peter.
Yeah, so that goes back to 07. 60 is the long-term average going back to the 1970s when we had our last bull market in precious metals.
Well, I think this was a pretty important low back in 2011. So 30, I hadn't seen that for a while, but you're saying in the 70s it was where, in the 20s?
Well, no, the average since the 1970s is 60.
Okay.
So so I still think that there's room to get back to that long-term average.
Okay. Yeah, I remember 40s in the 80s, 70s when I was young. So we've covered. Go ahead, Steve.
Yeah, Peter, you mentioned the disconnect between the markets, the financial markets and the stock markets specifically, and the real economy. I think there is no doubt that the goal here is to keep supporting the stock market until there is an actual rebound in the real economy, so then they can, in essence, let them decouple, move in tandem. Do you think they can actually succeed in doing that? I mean, do you think they can actually succeed in having stock indices completely ignore the real damage to the economy until the economy is not damaged anymore?
Well, it is a great question. I mean, I guess it's one of those things that they can until they can't. You know, that's the irony of the situation is that if the economy does improve, well, then interest rates really do need to go higher. And and that alone creates its own speed bump to any economic recovery. And then the Fed is going to be put into a situation where CPI is not going to be 1 to 1.5. It's going to be 2.5 to 3, 3.5 to 4 on an economic rebound, and they're not going to be able to just sit there with monetary policy currently where it is. So so that's the thing. That's the irony is that a stronger economic recovery actually can lead to higher interest rates and lower stocks, whereas weakness, as we saw, in the 10 years after the Great Recession, very anemic economic growth, but a very robust stock market.
So a recovery could kill valuations.
Yes, that's the irony here, because the recovery leads to higher rates, which would then create its own speed bump on any recovery, because the economy can't handle any notable rise in interest rates. The market certainly can't, but that's what you will get if I'm right on inflation. Now, I'm actually hoping I'm wrong on higher inflation, because that would be a disaster, I believe. That's the kryptonite of markets and certainly of central bank policy. So I actually hope I'm wrong on higher inflation.
Do you still have your win button from the 70s?
Is that, at the end of the day, is that really a bad thing? I mean, is it really a bad thing for the central bank policy to finally fail? I mean, isn't this probably the ticket for a next day with, much more prudent handling of monetary policy and the economies? Yes, it's going to be very tough when it happens, but I mean, inevitably it will happen at some point, right?
It will. I mean, in terms of control, I always like to look at the Bank of Japan. Certainly they've been able to manhandle the JGB market, but 30 years of easing still has the Nikkei almost 50% below where it was in 1989. So it's a perfect example of a central bank that can't bully in stock market. I mean, the Italian stock market is down 50% from its 2007 high with all the things that the ECB has done. So there are plenty of examples of where central banks are successful in manipulating interest rates because that's what they directly control. But that doesn't mean that it's always good for one stock market. And the stock market at some point becomes more a reflection of the growth profile rather than just following a central bank balance sheet.
One more question. You mentioned the deficits, and we've been talking about them all the time. Actually, my personal prediction here was that during the next recession, and that was years ago, the US deficits are going to hit 12%, but I was wrong. It seems they're going to be a lot higher. What is the threshold? When do you actually think that the market is going to say, okay, that's enough. I don't believe anymore that the US can ever repay its debts? I mean, how far do you think they can push the envelope before something like that happens?
Well, I mean, it was the mid-1980s when we were talking about the exploding budget deficit and what that potentially can mean for interest rates. And here we are 35 years later. So it's really difficult to say. I mean, it'll matter when it does. And it certainly hasn't mattered in Europe and hasn't mattered in Japan. So I'm not exactly clear when it matters here. It has the potential of mattering if the dollar does go on a sustained decline, because foreigners own a third of the US Treasury market. And foreigners are not going to just want to sit there and watch the value of their US assets decline if the dollar declines in a notable way. So I'm really focused on where the dollar goes from here in determining whether all these deficits will eventually matter for the Treasury market.
Okay, Peter, you bring this up and you brought up Italy, and it had me flash back to a guest that I had on Monday who is actually looking for the next big financial problem. Ground zero is going to be Italy, a bank in Italy, and some type of parliamentary vote in early August 8th, that could threaten that Italy's politics may take them out of the currency union. Do you foresee? Are you paying attention to what's happening over there? I mean, the Great Recession was triggered here. Could it be a European bank that's the next shoe to drop? And everyone really knows that most Italian banks are zombie banks.
Yeah, I mean, that's been the case
for a long time.
Yeah, I mean, the ECB has obviously crushed profitability, and it's why European growth will just be anemic for a while. I think because of the state involvement in the economy there, it'll just be natural for them to recapitalize. I'm really, in a way, more worried about where interest rates go next year if I'm right on inflation. To me, that's really the next. I mean, when you look back over the last 10 years and where the excesses are, it's obviously in debt, it's obviously in interest rates, it's obviously in central banks. And what upsets the entire apple cart is higher
Yields.
Inflation. And obviously we're in a deflationary period right now because the economy is so challenged. But if you get a vaccine and the economy's rebound, I'll say again that the supply disruptions that we've seen are not easily repaired. And I'd be surprised if we didn't have 3% plus CPI prints at some point next year.
Aren't we already seeing it in the grocery stores? Could it be foreshadowing what's going to happen everywhere?
Yeah, so I've been writing about that. I think is a dress rehearsal for what we're going to see at some point next year. And it's not just that; it's also in transportation too. I mean, good luck getting a truck to deliver things that you need, or getting a ship, because a lot of capacity is taken offline. I mean, look at the airline industry. When travel starts to pick up because people feel more comfortable because maybe there's a vaccine or effective antivirals, the airline companies are not going to be so quick to bring back capacity. It's not so easy to snap your finger and bring back 35,000 people that you just laid off, whether it's flight attendants or pilots. It's going to take time. So you're going to have full airlines and you're going to have much higher prices. Now, again, that's probably a 2021 event, but that is what I see ahead of us. And you can be sure that central banks will overstay their welcome with all this easing and won't be so quick to remove the punch bowl. So to me, that is what upsets everything is higher inflation. And again, I hope I'm wrong, because that would be a real mess for credit markets and interest rates. And then obviously that has a spillover into the valuations of equities, which are extraordinarily overpriced right now, because I still think it's going to be years before we get back to the profit level of 2019.
So your headline for today, and only Peter Boockvar could come up with it, is that a recovery could end the recovery.
Yeah, it can end the recovery in markets. Yeah, I mean, wouldn't it be ironic that the markets bottomed at the height of the shutdown and topped out on the
I was thinking about vaccine. That. Yeah, a vaccine. Yeah, interesting. Peter, thank you so much, buddy, for being with us today. I just want to show people your blog.
Thank you.
And let's see, where are you, Peter? Yeah, here you are. And people could subscribe to this. There's Peter's blog right there.
Thank you.
Something that, it's a great resource. You get this more in depth than you get on, Peter's 5-minute blurbs on CNBC. I think we're lucky that we have this format that we get to talk to him for a half an hour. So check Peter's blog out here. Thank you so much, Peter, for being here. What a nice twist on the whole thing, talking to a contrarian like you. I appreciate you.
I appreciate having me. Have a great weekend.
Okay, you too, Peter. Okay. Everyone, that's going to be a wrap. So remember, don't be worried about a recession. Be worried about a recovery. Everyone got that? The world upside down. And that's a wrap. I want to thank everyone for hanging out with us today. We'll see you tomorrow. Good hunting. Don't forget, you have to become part of this, because when we wrap, that's when things just start happening in the chat room. All right, so everyone's in there now. So continuation of the vibe that you have going here. In F.A.C.E, you just, click on these two little people here, and Blake will answer your questions, Steve will answer your questions, and we have traders in there that it is not a hobby for. this is how they make their way in the world, by pulling pips out of the market. So that's a wrap, everyone. I'll see everyone tomorrow. Good hunting. You're very welcome. We have a blast laying it on the floor for you guys every day. It's our mission to build up and edify traders every day. Adios.